Welcome back. Now, Standard Bank has reported a 4% rise in annual headline earnings per share. This thanks to lower credit impairment charges, cost containment, and a strong performance from its insurance and asset management units. The total dividend sits at just over 15 Rand, reflecting an increase of 6%. Daniel Masvosvere, Senior Equity Analyst at Ashburton Investments, joins us with his take on the performance. Daniel, thanks so much for your time this afternoon. So as mentioned, earnings rising 4% in the lower digits on that front, lower single digits. Was this kind of growth expected? I'm looking at the share price. It's sitting firmly over 3%. And I don't know what to make of it because the growth doesn't seem that great.
Yeah, so I think the growth was, let's call it modest, broadly in line with market expectations. There's a range there, but I think the share price reaction you're seeing has a lot to do with the outlook for the group, which is more constructive and positive over the medium term. They've lifted the ROE target range to 18 to 22% through to 2028, which has been obviously taken quite positively by the market. I think that it's important to have context for the 4% growth. You know, they grew earnings over 26% in the base year, so last year. So against that base, you know, I think it's a reasonable performance.
And I want us to look at that revenue line. Net interest income increased by 3%, but non-interest revenue was flat. And looking at its peers, you know, we saw a lot of those counters cashing in more on the non-interest income revenue on that front. Walk me through some of the dynamics at play when it comes to the top line for Standard Bank.
Okay, so I think on NII, you're seeing a buildup of origination pipeline in CIB. The outlook again, I think, is quite positive for loan growth. So if you're guiding to net interest margins coming under pressure into the next year, and still you expect net interest income to grow sort of mid to high single digits, that tells you advances are going to be seeing healthy growth into the coming year. So I think that's positive. Non-interest revenue, there's again a base effect there. Okay. So if you look at it against the history, you had growth in excess of 20% in trading income as an example. I think they did well in the spirit to grow that 3%. But again, you've got to look at it against the base. The BCB business obviously is in a more contested, competitive space in commercial banking. Now you've seen Capitec come into that space now. There's pressure on pricing and fees around the transactional offering there. So I think all in, that gives you some context to the numbers we're seeing.
You touched on lending growth and that we might see that coming through. Would that likely be on the corporate side or on the household side?
So I think across all the banks, you'll hear that, you know, they're certainly more constructive on the corporate side in terms of the expectations for loan growth. The pipelines there around infrastructure and energy spend are building up. And then I think we're sort of past the peak in credit losses on the retail side. Mm-hmm. We've seen inflation come down. We've seen interest rates come down, maybe not as much as everybody would have hoped for. But bottom line, it should be a more positive consumer environment to support credit growth. So you should see better retail credit growth. But yes, you know, business and commercial and corporate credit growth will run ahead.
Would you think that perhaps maybe banks, these lenders in particular, might adjust their expectations for household consumer loan growth, considering what we just received from the budget yesterday with that being hiked?
Yeah, I think so. It's a 0.5% increase this year, another 0.5% next year. I think if you listen to management of Standard Bank, there's no material shift in the outlook for loan growth on the back of it. Yeah, maybe it does imply some pressure on the margin here and there, but overall, you know, you have to look at that against, you know, the interest rate environment that you're in, the inflation environment that you're in overall for the consumer.
Let's look at the group's Africa operations, also performing quite well. How much of a risk are those currency woes, are those inflation woes on that front?
So currency was an 11% drag in this period. I think we've seen inflation across the different African countries trend lower. The outlook is certainly that, inflation in different African countries is going to be trending lower, at least the countries they operate in. And with that, the currency volatility we've seen in the prior periods should not repeat. And if it doesn't, we get more stable currencies, and certainly the negative currency effect we saw in this period does not replicate itself into the next year.
Let's look at that insurance and asset management unit in greater detail. They've also said that that unit delivering strong growth, ROE and earnings growth in the double digits. Your thoughts around the factors that fueled growth on that front?
Insurance and asset management, I think, a lot of it really is coming through the asset management business. So assets under management or administration or advice, that was up 13%. Asset management, obviously, fixed cost business, you do see positive leverage to the extent you're able to grow assets and related to that revenue. So that helped. And then obviously a more positive environment for investment returns on the shareholder portfolio helped. A positive revaluation of property assets in the property portfolio, again, also helps the performance in insurance and asset management. The insurance piece, earnings there plus 3%. So that's not really the biggest driver of performance there. But you have a more optimal capital base in that business, and all that together helps the ROE.
And Daniel, before I let you go, how do you think Standard Bank now fares against its peers? I mean, when I'm listening to you, it does sound like we are seeing somewhat of a normalization in their results from, a period where they were delivering double-digit growth to now, that normalization just coming through. How does Standard Bank fare against its peers?
I think, at an 18 to 22% ROE target range, that's certainly right up there with some of the leading peers in the sector. So with the Capitec, FirstRand, and then you have Standard Bank coming in at a close third in terms of the ROE that they are currently delivering at 18.5% and what they're looking to deliver at an 18 to 22% range. So the direction of travel for the Standard Bank Group is definitely very positive. They've got a strong growth story in Africa. You're seeing them make good progress on cost management across their business after years of investment, and so I think the story overall is quite positive for the group.
Daniel, thanks so much for your time and just your analysis on Standard Bank's full year numbers. That was Daniel Masvosvere, Senior Equity Analyst at Ashburton Investments. Do remember to tune in to The Close with Zinati at 5:30 today. Standard Bank CEO Sim Chabalala will provide greater perspective on the numbers just after 6 p.m.